Good morning, good afternoon, and good evening. It's Friday, April 21st, 6:08 p.m. Welcome to the latest episode 74. Be Observant. This is your host, Mark Yu,
And Wabi Santos.
and welcome to the Mark Yu and Wawi show. So, just as disclosure, we're both workers in the healthcare field, and we have passion and interest in the stock market, investing our hard-earned money. So, me and Wawi basically try to record once a week or as much as we can.
As much
But
as we can.
recently, it's been hard due to our work schedules, but we try our best to share our knowledge and our research. So you guys are in for a treat tonight since we have a lot of charts to show. Hopefully, we manage to share everything and our opinion on it. We're not, financial advisors, but we've been investing for several years. I myself have been in the market both in Asia and Philippines and here in the US since 2014. And Huawei is also about the same, right? Huawei around 2018.
I started actively investing in 2018.
All right, so here we go. We are gonna dabble into a lot of charts today, starting with some sentiments. So this comes from freely from the American Association of Individual Investors. Let's see if they're bullish, meaning that if they think the stock market will go up or stock market will go down. So for this week ending 4/19, there are still a lot of bearish investors out there thinking the stock market would go down. It increased from the couple of weeks prior, even the week prior, to 35% compared to their average of 31. The bullish investors, they're around 27%, a little bit more, 1% more than the previous week. But in terms of its average, definitely a lot less. Then, okay, let's look at the fund flows. Oh, the volatility index for the past 5 days. So the volatility, if it goes up, most of the time the stock market goes down. So volatility is down 5% for the past 5 days, which is interesting. While the S&P 500 is flat, barely did anything at all during the busiest week in earnings season. This is the busiest week. Next week, we're gonna dive into a lot of big tech reports, so that's gonna be much more interesting. But yeah, it's barely flat, despite a lot of rumors that we're about to go in a sell-off mode or bear market. But if we're gonna take a review, the S&P 500 is actually up 8% since the start of the year, which is impressive.
Wow.
Volatility is down 26.7% since the start of the year.
It went up a few percentage points yesterday, but I'm happy to see it's down again today.
Right. Well, that's interesting now that since even start of the year, they were predicting that we're gonna be in a recession sometime soon, or if not, we're already in it. So earnings estimates, which we're gonna take a look at, provided by FactSet, so far this earnings season has been going down. So we're gonna take a look a little closer on the numbers. So for the fear and greed index, so we would like to see if you're optimistic, actually you want to be contrarian and you want to see fear in the gauge. That way, it will prompt you to do the contrary, to start buying into fear. That way you're buying at a little bit depressed price. Whereas right now, currently we're at greed. So not quite a good signal to buy at this point in time. Compared to past week, actually, we stayed at greed territory. The market momentum, look at this. It's been on the positive trend, positive above 125-day moving average since March 14th. So it's more than a month and 6 days now, more than a month and coming to a month and a week so far that we're above trend. And so far this year, we have spent more time, honestly, above the 125-day moving average, which is a good sign, right? Being optimistic and right now,
Definitely. If you're a long investor, this is good for you. If you're a trader and you're short, then of course it goes against you.
exactly.
So
whereas last year, we even in this graph alone, you could tell last year we have spent most of the time deep red down under. So this is welcoming, at least a good sign, a little bit reliever. So yeah, but the volatility has been down. So here we go to the flows. How's the flow? Where's the money going and stuff? So we now have investors selling out of global stock equity funds on recession fears. This is as of today, this morning, that was published. According to the Reuters, rising concerns of a recession following weaker economic data and expectations, the Fed will keep hiking rates to tame inflation, led to outflows from global equity funds in the week ended April 19th. Data shows that investors sold 2.25 billion this week, with compared to a 215 million net purchase a week ago. So a lot of selling you can see in this graph as well. What's outstanding in this chart provided by Reuters Refinitiv Lipper data is the massive dump of investors on the money market fund. It's definitely an outlier since the start of the year. A massive dump. Another information that was published this week was the US Leading Economics Index, which is a gauge of future economic activity. So this is a good index to track to see where we're headed. And it showed here it dropped to its lowest level since 2020 overnight, signaling a recession starting mid-2023. So we're coming into that right now, 3 months ahead in June. So further summary of this one thing to definitely take note, the US Leading Economic Index, which is I think provided by Conference Board. I have a chart in a little bit to show, like to just see like where are we at current time. Or going back to the flows, European and US stock equity funds suffered outflows, 1.6 and 1.4 billion respectively. Asia drew in about 1.1 billion, which is interesting. So I guess honestly, I'm gonna speculate that this is the money that's following Warren Buffett to Japan. What do you think, Maui?
I agree. I agree. So when the US market has done their experiment, raising rate hikes, Japan is doing the opposite, easing. So when our trajectory is going down, we're gonna go to Japan and recoup some money over there.
Locking in some trying to follow where the richest man fundamental investor out there.
And they don't buy costly equities. They buy equities very cheaply, and Japan is struggling right now, so it's good.
So this is a CME Group market tool that gathers survey from experts. They now think that 89%, there's an 89% chance that the Federal Reserve would hike up 25 basis points this coming May 3rd. So watch out for that. So here we go. So for the money market, that big drop there, 89 billion exited global money market funds after a 7-week buying spree. Interesting. For the commodities, precious metals recorded their first weekly outflow in 6 weeks. Emerging markets, investors purchased 384 million worth. And it's the 4th week of net buying in emerging markets. So people definitely following Warren Buffett to the land of the emerging markets. So on to our next earnings insight from FactSet. This was just published today. According to John Butters, first quarter earnings season of S&P 500 is off to a better start relative to the last 2 quarters. That's interesting. However, both the number of companies reporting positive earnings per share surprises and the magnitude of these earnings surprises are below their 5-year averages. So despite beating estimates, they are still below their 5-year averages. This is because more likely they already ramped down, the expectations. Like they're projecting lower profit, lower revenue, lower sales. So it's easy for them to beat those estimates. Overall, 18% of the companies that have reported for the first quarter, only 18% have reported so far. of these companies, 76%, wow, 3/4 have beat earnings per share estimates, which is interesting.
That's a good sign.
5-year average of 77%. So this is what FactSet is saying. It's a little less than a 5-year average, but 1% less, that's not bad. Yeah, so looks like furthermore, positive earnings surprises came from multiple sectors led by healthcare, which is the largest contributors. Positive earnings surprises also includes financials, and then some offset by downward revisions to earnings estimates by energy sector. So energy tampering down expectations, positive earnings surprises reported by financials and healthcare. So 5 of the 11 sectors are reporting year-over-year earnings growth. So these are the 5 sectors that are reporting growth for the first quarter: consumer discretionary and industrial sectors. On the other hand, 6 sectors are reporting decline, led by materials, healthcare, IT, and communication. So that's interesting. Big tech is part of information and communication, but they're reporting year-over-year decline. Whereas healthcare, oh, yeah, healthcare as well. Healthcare, IT, and communication. So are we gonna be expecting bad performance next week from the big tech? That remains to be seen. But healthcare, meanwhile, you could tell that they have so far beat positive earnings surprises, despite being expected to deliver a year-over-year decline in earnings, which is a little
Definitely something to watch, because that might indicate a rotation on the economic cycle once we see some of these down pressured companies moving back up in the information technology. But definitely people are still finding refuge in healthcare and consumer staples. As you can see, Dollar General did well. Community Health did well today. So those are very good signals that
right.
the economy is still very resilient.
Yeah, speaking of being resilient as an economy, Bloomberg came out with an article that says these U.S. states saw their jobless rates fall to record low in March. So we're seeing record low of unemployment rates or jobless rates in Montana. What's SD?
South
Arizona,
Dakota,
South Dakota, Wisconsin, Ohio, West Virginia, Maryland, Maine, Kentucky, Arkansas, Mississippi, Alabama. So typically you should be you should be seeing higher unemployment rates if we're in a recession. But unemployment has gotten lower, historically low since 1976. So it's just hard to predict. Speaking of, I was able to pull this chart from I think it's bar chart, which is really good. If we're gonna take a look at anything else aside from volatility to predict a drop in the S&P 500, I think this is the best chart to look at. This is the S&P 500 and the unemployment rate. So this is let's see if I could make it bigger. Oh, there we go.
You can see the steep drop there.
Yeah.
In 2020 when the COVID pandemic hit.
So this is, yeah, this goes back 20 years. So 2003 to today. So every time the unemployment rate spikes, we go see a recession. Well,
yeah. Some of them are lagging behind, but definitely during the pandemic shutdown, you could see the correlation on the
right
two
here,
intersections.
unemployment, right? Well, definitely in the pandemic, right?
Because they had to shut down everything.
Not quite a strict 1:1 correlation and inversely proportional. But
it's a lagging effect that you can see in a normal situation.
right. So next we're gonna tackle, let me just adjust the screen here.
So that's why the Fed has to be careful, because
Mhm.
we have a strong job market, and if they break it with pressuring everything to be so high as far as borrowing rates, we're limiting growth right
Right.
now. But
Yep.
the nation is demanding growth because there's demand for homes, demand for new factories, demand for more goods.
Mhm.
There's a very strong demand, and that's what they're trying to tamper down. Unfortunately, we can't get that demand filled because the supply chain global is still affected. It's still
Right.
slow.
And there's this another leading indicator that we talked about just now. There's a conference board of leading indicators. So whenever it goes down, you could tell we're in a recession. So right now the blue line is what we're looking at, and we are deep down under as of its recent report on March 2023. That's last month. So deep down on the red, negative territory, close to 10%. And that's when we have recession. But right now we still aren't being told that we are. NBER hasn't come out with anything. We don't feel it. Unemployment is on the lows, historically lows in a lot of states. But regardless, it still signals a recession over the next 12 months, according to this graph.
Mm-hmm.
So another article from Bloomberg says that foreclosure is less steep on dollar value basis. So for some, it might, raise a little bit of alarming state, but I don't see the necessity to do so, because Black Knight just came out today again, and fresh from the oven, of their first look of last month, March 2023 mortgage data. They are saying that the national delinquency rate actually dropped 15%,
Wow,
falling below
unbelievable.
3% for the first time, ending at just 2.92%. So I don't know.
It's
Delinquency,
very strong.
yeah, delinquencies are good. Both foreclosure starts, I think this is the one that Bloomberg is referring to, but we're still pretty low in terms of, I think, compared to history. Both foreclosure starts plus 9% rose in a month, but still remain well below pre-pandemic volumes at the national level. So I don't see any necessity, despite people, trying to post scary stuff about mortgage, high interest,
Mm-hmm.
that will send housing market down to the toilet. I don't just see that happening anytime soon.
Well, some of the central bank governors have been indicating a real soft landing this today. So if we can trust their words for it, looks like, and couple it with the signals, there's a likelihood that that can happen.
Right. So it's another chart here. So this is in contrast of the Conference Board Leading in Economic Indicators Survey. So this is the S&P Global Flash US PMI Composite Output Index. So we actually turned the corner right now to the positive side.
Mm-hmm.
So it would have been alarming for it to go continuously down, but this bounced back up. And what's good about this is what I got from the Charles Schwab survey information. So the chief business economist said the latest survey adds to signs that business activity has regained growth momentum after contracting over the 7 months to January. The latest reading is indicative of GDP growing at an annualized rate of just over 2%. Growth is also reassuringly broad-based, led by services, thanks to a post-pandemic shift in spending away from goods. So this is interesting. We're seeing rebound now in some surveys. So we're gonna see in a little bit, because there are lots of data being thrown left and right. But the thing
Mm-hmm.
is, looks
On
like,
the news on Bloomberg, they said that there's a rise in new hedge funds starting startups for this year, and they've been indicating a large one that might be headed by Bobby Jane,
Mhm.
or how you say it,
Oh, I think I can't hear you, Wawi. Oh, audio. There we go. There you go. That's
Okay,
cool.
sorry.
Mhm. It's all good.
Okay, can you hear?
Yeah. So we're just looking at the year-to-date returns right now.
Can you
And
hear me now?
yeah, I can hear you. So
Okay. So what I was saying,
mhm,
listening to Bloomberg, I didn't
mhm,
know I was muted. I muted myself. Anyway, they're saying that there's quite a few new hedge fund startups this year, and that's another indicator if we look at the news that they're expecting some movement,
mhm.
for the positive for these startups to start taking positions right now.
Yes. Speaking of hedge funds, I was able to pull up a chart from Bank of America here. They're actually this is a global fund manager survey. They're actually very bearish. They're very lightweight. If anything, they're short the market a lot. Not
Mm-hmm.
seen since March 2009. So despite that, the market just keeps rallying since year to date.
Mm-hmm.
We're up 8%. Technology is the best performing sector, 18%. A little less performance on energy, the worst performer at negative 1.2%, which is bad. Utilities, it's negative 0.5%. So everything is a little more bullish this year compared to last year, that's for sure. Are they coming in late, or what can be expected? So they need to outperform the market pretty soon. And if anything, they need to go against the tide. If everybody is betting that the market would go down, somebody needs to bet on the other side just to make sure that they they gain some
Mm-hmm.
alpha in the near future. So I guess we're gonna cut things short right now. While we're now down to our last chart, last segment for this recording. We're seeing the Morgan Stanley survey expecting so for the unemployment rate, they don't see a spike actually, according to this chart. We're only seeing 3.8% for this year, 4.3% next year, 4.4 the following year. So I don't know. Are we gonna see a lot of pullback, another bankruptcy? Which I doubt, right? Because they already assured the public. So where else can we be struck by a black swan?
Well, sorry to be laughing, but I think we just need to prepare for a shock
Mhm.
because right now there's still a strong possibility that a shock can happen.
Right,
We may not be seeing the increase in unemployment rate right now, but there could be a wave effect later on, or what you call a ripple effect from
right,
all of these consolidating.
right. So it's always good to keep an eye out for sure.
Hmm. So just keep your emergency fund, um, when you stay within your comfort zone when you're investing.
Mm,
Um, Make sure you pull out if you can't stand the risk, and take profit.
right,
Uh, I always remind the group to take profit when they need the money, and take profit when you feel like it's gonna go the other way of your bet.
right. I totally agree. Well, I guess that does it for today's episode. A little bit short but sweet. A lot of information, a lot of charts.
Hmm.
Thank you for making it. Thank you for joining us. It's been a
Thank
couple
you,
weeks.
Mark.
We've been busy, so I'm grateful
Hmm.
that we were able to do this week. Until then, well, thank you guys for listening. Please follow us or subscribe and hit the like button just to show your support. Otherwise, have a good weekend, guys. Again, this is Mark Yu signing out.
Wawi Santos, like and subscribe.